And similarly, I'd like to also thank the sponsors that have helped us come here today and come together. Certainly Central Highlands Toyota, Qantas for helping us get out here. Without their support, these events simply don't happen. So thank you very, very much. I have a clicker up here somewhere. There we go. So I'm here today to speak about the Central Highlands economic profile that we were engaged by the Central Highlands Development Commission about 2 or 3 months ago to pull together for the Highlands to get a real sense of what's been happening up here. Very timely in terms of, as you'll all be aware, some of the census information has started to come out through July. Importantly, some of it's come out, but not all. And over the next couple of months, we're going to get a much deeper dive around the kind of jobs, movements, how people are moving from work and from home. And that information is going to continue to feed through in this process. So in talking about some of the numbers that I'll be talking to you about today, the important thing to recognise is that they are continuing to evolve, and that we're going to be continuing to work with Central Highlands Development Corporation to give you guys the best picture of what the numbers are telling us about your fantastic region. So very quickly, our brief in preparing the profile was to really get a sense of what's been happening in the economy. As I said, it's very timely and driven by the census, and most importantly, the Central Highlands Development Corporation are currently finalising that profile, and it's going to be publicly available on the website soon. So if there's anything that takes your interest today, by all means, ask a question, but you can also take a bit of a read when it's coming up on the website very soon. So what we're talking about today is a story of growth. I think there is a lot of media interest in terms of, from time to time, the peaks and troughs that you see in an economy. But at the end of the day, what we've got here in the Highlands is a very strong story of growth and challenges around infrastructure, around skills, around labour that are associated with that growth. So if we look at some of the, I suppose, the key snapshot numbers, and I apologise if you can't read from up the back there, but as of the 2011 census, we had 34,000 odd people living in the Highlands, called the Highlands Hub, and that was well above what the state government had predicted we would have by that time. So they had their own projections that tell you where we expect you'll be, and even under the high scenario, we thought about 32, we've ended up close to 34. So we know that we're growing very quickly, and if we take those figures out, we're looking at over 50,000 people by 2031, which is really significant for a region in terms of what that means for the infrastructure that can trigger in terms of the size and scale of what a population of this size starts to demand. We know that we've been growing over the 2006-2011 period around the same pace as Queensland, which is encouraging, but looking ahead, we're going to grow a lot faster. So there's 2.7% growth there over the next 20 years or so. The next one, though, is particularly interesting, though, that obviously for many of you who work with contractors, employ a number of contractors, we've got quite a sizable non-resident workforce that commutes to work on a regular basis. And getting a handle on that population figure can sometimes be difficult. But from what we do know, and what the state government has looked into, we know that that's going to accelerate growth over the next 7 years in particular to be even higher than we may have anticipated. We know we're a young region, so the average age out here is 34 rather than 37. And we know that we're a region that if you're looking for a job, you can probably get one. So an unemployment rate of 2.36%, which is quite low, compared with 5.5% for Queensland. The figures have just come out. I think Queensland, as of 2 days ago, is up to around 6.2%. And the Highlands has remained quite low, and I think it will come down to about 2.2%. So we know that we're a region that's currently got, I suppose, when you take into account churn, you're between a job, that's all that 2.3% accounting for. So if you're looking for a job, you're typically able to find one. In terms of a participation rate, so people who are actually engaging in, who are the right age, who could get a job, they're certainly looking. We've got more people looking for work and getting it than we're seeing elsewhere in Queensland. We've got a labour force of about 20,000 people strong working in the region, which is a significant proportion of the 34. But we've also got a sense from the state government's investigations that we've got an additional 5,000 people who are coming in, driving, flying, or in short-term stay accommodation to reside and work here in the Central Highlands. From an economic perspective, we'll talk about GRP in a little bit, but a big, scary, exciting number there in terms of $4.5 billion. contributing that 4.5 billion to the 266 billion odd that is the value that's added through the Queensland economy. We know that people here are relatively well off on average in terms of what the weekly pay packet looks like. So closer to $2,000 per week per household as compared to $1,200 across the state. That's got some pressures as well that I'll talk about in a little bit. In terms of accommodation occupancy, so here at the Explorers Inn or elsewhere around the region, we know that it's relatively high, and we're seeing that across the board, across the year. So it's not even seasonal. The question is that tourism traffic or is that contractor, is that worker traffic? And at the end of the day, it's a combination of both. But the answer is very simply that we've got pressures placed on our accommodation offering here in the Highlands. Another interesting stat down there, which is worth noting as well, is the growth that we're seeing coming through our airport. So in the last year that we've, so 2011, 2012, we've had 257 odd thousand people coming through the airport, which is up 53% from the year before. So, as I've said from the outset, it's a story of growth that we're experiencing here in the Highlands. And I think if you can take one thing away, it's to think about the fact that we are growing. We're going to continue to experience challenges associated with that growth. I'm going to take a little bit of a deeper dive into some of those figures just quickly to give you a bit of a comparative analysis, and we can certainly talk about those later, and as I say, I encourage you to have a read of the profile itself. So in terms of population growth, looking out from where we are at the moment to 2031, the top line is exactly the growth that we're expecting in Central Highlands. Fitzroy's the grey line down below, which is kind of the broader region out here in Central Queensland. Sorry, no, that's Queensland down the bottom, and then Fitzroy's in the middle. But once again, reiterating that strength of growth that we're anticipating in our population over the next 20 odd years. Looking over the last couple of census years, we are seeing some changes. So it's a growth story, but the question is, where is that growth coming from? And I put it to you that that's in a couple of key demographics. So if we're looking at this as an age split down to size, so if you fall into certain age demographics when you fill out your census form, we know that we've got a strong growth in young families. So it's this demographic here and the one down the bottom. So that 25 to 34 and 0 to 4-year-old growth. We've got a strong growth in our mature age population as well. So certainly, rather than what we've seen in many other regional areas around Australia, around Queensland, you'd start to see people leaving the region around those times, seeking services, seeking coastal lifestyles, seeking other opportunities. But we're seeing that population grow in Everett, which is quite interesting. When we then compare, Paul's just said he's not going anywhere, so you stuck with him. And nothing wrong with it, it's a great place to live. When we compare though Central Highlands, which is the light blue, with Queensland, which is your dark blue up the top, it tells another interesting picture. We can see that in terms of the light blue, we've got a really strong male working age population, and that's no doubt driven by, I suppose, the male-dominated industry of the resources and associated construction sectors. I'm not saying in terms of gender sex one way or the other this morning, but that's certainly a strong trend that we see out here in the region. Once again, the younger family demographic perks up and tells us something there. But at the same time, what we're seeing is smaller proportions of school age and tertiary age students here in the region as well. So we've got a great region, a strong working age demand. We've got a strong family demographic, but we are losing, and we saw on the slide earlier, a shrinking population of school age students. When we're talking about that story of growth, what we've got here is a little table that shows a very clear trend. Central Highlands is growing. And the blue line down the bottom is the resident population growth that we anticipate to see. In 2011, the Queensland Government's Office of Economic and Statistical Review essentially produced an estimate of, looking forward for the next 7 years or so, what is the non-resident workers on shift population and what does that mean? So if you start to add those up, it creates an interesting narrative for the Central Highlands in saying that of those that we're broadly aware of, if we put that out to say, where would we be if they weren't here? We're bringing forward demand for infrastructure, for health services, maybe 5 to 6 years on what we might have previously anticipated, prior to obviously the economic demand for these workers to come into the region. So when we're thinking about how we're planning for services, how we're planning for roads, how we're planning for the airport, as we've already seen, is growing at a rate of knots. It's important to recognise that we are a growing region, and the economic story here is driving continued growth. When we look at population and heritage, it's always an interesting one to see who makes up our population. When we talked about the new numbers coming out from the census, there's a lot more information coming out about this one, but what we do have at the moment is where people were born, and so we've got a proportion of people by their country of birth. In terms of our Indigenous population, we have a population of about 3.7%, which is not common for a regional area, or for any area. That's growing roughly in line with the rest of the population, so not necessarily a distinct trend. What is particularly interesting though is the growth in overseas born populations who are moving to the Highlands. So when we compare to the census back in 2006 to 2011, we've seen the total overseas born population grow by about 7% year on year. Most prominently, we're seeing that coming through from the United Kingdom and New Zealand, as you'd anticipate, but also from the Philippines, from South Africa, from Sri Lanka, from the United States. And that's creating an additional opportunity, I guess, to a degree in terms of the social fabric we've got out here in the Highlands. So, most importantly, that proportion of population, I suppose, in 2011 made up about 13% of your population here and is growing rapidly. So we've got a multicultural region. When we start to talk about the labour market now, we can once again see a trend of growth. So your population is growing, you'd expect your labour force to grow. So your labour force is anyone who is aged 15 or over. And then we look at whether or not they're actively seeking employment or not and what that might mean. So we've got a sense that over the past few years, we've seen that labour force number grow up to somewhere in the magnitude of about 20,000 people who could potentially be seeking work. But what's interesting is that at the same time, while that population has been growing, the actual, the labour force or the actual those engaged in employment has shrunk a little bit. So while we've got more people moving into the region or moving into that working demographic, we don't have necessarily all of them then deciding I actually want to seek work. So that tells a story in terms of the fact that there's a proportion of the population there who, for a variety of reasons, may decide that they're not going to seek work. And I suppose for the council and for others to consider how can we provide the environment, incentives, training or otherwise that may want to encourage some of this population to potentially seek work. The unemployment rate, this is just reiterating what we've already said. We're low, and I think as I was looking at the figures earlier this morning, they're down around 2.2% for the Highlands, as compared to somewhere up around the magnitude of 6.2% in Queensland. So the figures we've got there are for Brisbane in the light blue line and the rest of regional Queensland in the grey line. So we're not just talking about a metropolitan-driven trend here, we're talking about the fact that the Highlands has significantly lower unemployment rate, which means you have challenges for attracting the right people to your business. You have challenges in sourcing the skills that you need to drive, I suppose, the growth into the region that you might want to have in a few years' time. So that creates its own incentives and challenges. I think it was the Western Down Mayor who was speaking yesterday was saying that they've had to accept that we can't compete on wages alone. We need to be looking at, we've hired a cleaner and a gardener so that our council staff can have that incentive of having the gardens looked after for them, have the house cleaned, and that's how we're going to retain our staff. We're going to look after them. But it's having to look outside the box a little bit in terms of what we can do beyond just wage competition, because not all sectors can obviously afford. I spoke earlier about income distribution, of having a household income of $2,000 a week on average, and this figure just shows a bit of a distribution, if you can imagine. If you can think of what you typically expect as a bell curve in terms of where you'd see a lower proportion of the population with a very low income, a lower proportion with a very high income, and you'd expect this significant middle class. And if you look at the light blue line, to a degree you've got something of a bell curve. You've got this light blue line that says that most people are grouped in a median income somewhere across here in Queensland. However, when you look at the dark blue line, we see very quickly that 25% of Central Highlands residents, so we talk about personal income here, not household, are pulling in $1,500 a week or more. Now, most significantly, that has real price pressures on the local economy. That means that it's more expensive, 4% more expensive in Emerald and 8% more expensive than in Brisbane, just to purchase anything to local shops. And look, there's a degree of that that's regionally based, but there's also a degree of that that's going to continue to be experiencing that pressure as a result of just personal income. And once again, just reiterating that. So in terms of what we've seen in terms of the growth and the differential between the rest of Queensland and the Central Highlands over the 2001, 6 and 11 censuses, we're seeing this growth in median weekly personal income that's just growing at a much faster rate of knots than what we're seeing elsewhere. A few more key figures. GRP, gross regional product. Now this isn't everything that's produced by an industry, but it's very much more something that looks at what are the profits and the wages paid by that industry. So what's the wealth that's retained in the local economy? And unsurprisingly, the resources or the mining industry accounts for a significant proportion of that, something like 70%. Outside the industry though, we're seeing, I suppose, a strong contribution in construction, agriculture, forestry and fishing, and a variety of other sectors that are making this, that are contributing to that economic wealth that's flowing through the region. I've been given this sign, so I'm going to move through relatively quickly to round out. But if we could, I suppose, synthesise from what we've seen, looking at what we know of the employers in the region, we know that agriculture, resources, tourism and construction are some of the most significant economic contributors locally. And that's really significant for the Highlands because it's a story that matches up with where the government, the state government, wants to offer incentives and support that growth. So it's a matter now for the region to consider how do we engage with some of those incentives and engage around that conversation that's going to encourage continued growth in what we are already experiencing as our economic strengths. I won't talk too much to the housing market because I know Pat's going to give us the whole story very, very soon. But to 2012, we've got some brief information there about median price sales in the Central Highlands, which are below those that we'd experienced or seen in Mackay and Gladstone, higher than those in Rocky. Comparatively though, rents have been growing at a much faster rate, which, as you'll hear, I'm sure in a moment, anecdotally have eased a touch, but still at a relatively high rate. So in summary, if I could really drill it all down, the Central Highlands is a region that's characterised by growth, rapid growth, and demographic change. And that's where those challenges are going to come for the economy and for your businesses locally. We've got affordability challenges, yes, and a degree of concentrated economic value in the resources sector, but at the same time, that's not the whole story. It's a sector that flows through and supports the local economy. And it's a matter of understanding how we as businesses can engage with those parts of the economy that are growing and buying, and adapting our business to be diversified to account for the dips and trends that we're going to see along the way. One final point. This profile has been an interesting little opportunity to take a look at your economy. We're going to continue to reiterate and look through that as some more data comes out in the next month or two. But going forward, we're now also working with the Central Highlands Development Corporation to look to the next step, which is, okay, you've identified your businesses and your areas that are probably have got the strength in the region, but how can we work with you further? How can we support further growth in the industries in particular that are going to drive, the next 4 years of this growth story? So we've just put it very simply there in terms of the exam question that we're working with the team around, which is around how do we achieve the short, medium-term economic development outcomes necessary to realise the community's long-term vision for a diverse and prosperous economy. So if you're going to come up afterwards, I'd love to talk to you more about that. I'd love to talk to you more about some of the things we've discussed today, and I'd encourage you to go and have a look at the profile that will be up on the website very shortly. There are a couple of characters who are around the room I know today who we'll be meeting with shortly after this presentation to discuss and take this economic development strategy further. So I'd encourage you to speak to them, to speak to us, and enjoy the rest of your breakfast. Thank you very much.
Thank you very much, James. As I said, a very enthusiastic young man, and as you'll see this morning with the suite of speakers we've got, you'll find that the information that James has actually tossed out there, they'll actually glove in with some of the stuff that Pat will talk about. So a lot of numbers, a lot of statistics, and I guess if you've come here for a haircut this morning, you're going to get it permed and coloured very, very quickly, because you'll note that, you know, some established sort of thoughts about our economy that we've had and about our demographics are going to change. So I think the interesting thing that has come out of it, things have changed very quickly. That's a great thing. I think we're all benefiting from that. There's opportunities there, obviously, but also there's the challenges, and I really appreciate James' comments there at the end about those challenges going forward. Now on to more important things like the Melbourne Cup. We're going to have Pat Lyons talk to us now. Most of you know Pat. Pat established the Central Queensland Taylor Burn office in July 2002, some 10 years ago. He commenced his career with the Valuer General's Department. His career's been long and arduous there, I know, working out of Brisbane, Maryborough and Toowoomba. I bet he wishes he wasn't there now. As District Manager of the Department of Lands and Natural Resources and Mines, Pat's been in Emerald since 1991. He has extensive knowledge of this region. I think he's widely known around the place. He covers valuation and land generally, but he also covers water and vegetation issues across this region. He holds a certificate in real estate valuation and AAP Certified Practicing Valuer. And Pat will give you an insight into some of our local issues. Thank you, Pat.
Thank you very much, Kerry. I'll just have to make sure that I can work this little clicker here. There we go. We're away to a great start. Good morning, everyone, and it's my pleasure to share some thoughts this morning on the overall property picture in the Central Highlands. It's far too early for Melbourne Cup tips, or the Emerald 100 for that matter, but hope to see you all there on Saturday. Just probably a quick overview of points of the presentation. I'll very quickly go through a bit of an overview of historical trends and some activity trends currently. One of the things I do want to spend a little bit of time on, because it's very critical to what happens here, is the relationship between coal pricing and mining activity and housing values, and some broader trends and influences about what I think are the primary drivers in our real estate market in the Central Highlands, Emerald in particular. For those of you who probably have been here for a while, you would have noticed that the market was pretty warm early in the 2000s, and it went pretty quiet about 2006, and then it increased again significantly in 2011, the first half of 2012, and I think now we're sort of in a holding pattern. There was a significant downturn due to interest rate increases in the global financial crisis in the general economy, but it didn't seem to affect the real estate market overly. Sales volumes peaked between 2005 and 2007, and again in 2011 and into 2012. You can trace that all back to property listings, and I'll put some graphs up shortly that show you the variation in activity over the period of time. Rental values seem to follow the market, for houses, and it all comes back to what I think is a common issue at the end of the day, is the availability of vacant land. My summation of what goes on, or of the statistics, is that just about everything can be traced back to the availability of vacant land. If the vacant land is available, private enterprise looks after the rest. Private enterprise doesn't have, governments, I don't think, or for that matter mining companies, don't need to concern themselves with building houses. They need to concern themselves with making land available. Just a quick statistical analysis in Emerald. You'll notice there that 2008 it shows a 2.2% decline in value. 2009 was 6.7%. People say that was in the middle of the GFC, but what it was about the apples that were in the barrel that can distort statistics. Was a lot of new housing stock came into the market at the time, so the average value of houses increased principally because the quality of the housing stock was better. But you can see the strong growth in 2011 of 10.4%, and up until August of this year, 8.2%. Going forward, we're not so sure. That's another graph that indicates that steady growth since 2002. You can see what's happened through what would be described as a pretty poor time in 2008 and the levelling off of the market from the end of 2006 through to 2010. We don't have the RP data, hasn't produced the graphs yet for 2012. So that's a little bit of a graph of statistical evidence. There's a blip in the main figures there, not quite sure what it was, I couldn't find it in the statistics. But what it shows is the average, the median sale price in emerald from September last year to July this year, and you can see the significant growth. It says that as at July 2012, the median house price in emerald was over 480,000. That increased from 430,000 in September 2011. I think that that's a pretty good snapshot. I think that pretty much tells what's going on. I'd be out pretty much for the accuracy of that. House sales per month. Once again, very good indication of what actually happens in the local economy. You can see the numbers slow down in 2008, 9, 10, and then we're starting to increase, and we're up to August in 2012. Some of the data won't be through the RP data yet though to be able to actually record that. Quarterly house listings. You can see as the market peaked, the number of listings actually drops off. When the price keeps increasing, there's less stock in the market. On to units, you can see that the growth in units is probably a little bit stronger than what the housing increases were. One of the things that isn't recorded in there is that there is a significant number of sales off the plan in late 2011, early 2012, which won't appear in the statistical data until such time as those units are finished. So I'm not quite sure how many have been sold, but I know there's a considerable number. And that graph also shows that holding pattern between 2006 and 2010 after the rapid increase from 2002 through to 2006. And you also see in the last few months, you're seeing that the price of units has gone up. There's obviously something in the August 2012 sales which are above average stock. I'd expect to see the next one flatten out. Unit sales per month follows the same curve. With land, we're up to, after a slight fall in 2009, there's been slight sort of growth through 2010, 2011 and into 2012, but there's very little stock, and the sales are now coming through in 2012 showing 4.8% are all the sales out of Mayfair, which are a little bit below the average price of normal blocks in town, so it just distorts that a little bit. If you look at the statistical analysis, you see pretty solid turn up in the average value of vacant land from the end of 2010 to 2011, and that's because of the shortage. The most recent median sale prices in May, there would have been some sales of, I'd say, there's a couple of rural residential lots in May 2012, which distorts the RP data analysis. You'll also notice the decline in the vacant land sales per month in 2011, and you don't have to be Einstein to work out why that was. There was incredible demand, but there's very few sales, and the reason why there's very few sales is because there was no stock to sell. So that answers the question. You turn that upside down against the other graph and you'll notice the number of sales, listings go down, the price going up, and you've got a lack of stock. This is probably, I think, the most interesting piece of statistical analysis that I've tried to do, where I've overlaid the median sale price, rental listings, median weekly rental, and thermal coal prices. I can't get the graph for the metallurgical coals. But if you follow the Q2 in 2008 and look at the blip that you get in the other lines at that time, and just recently we've had the rents going through the roof. like the median rent going through the roof and the price of coal actually going down. Something's wrong in that dynamic. And I think it's about to correct itself. I think it has corrected itself because that median weekly rental I would suspect has now come off by about $200 a week. In Blackwater you get the same sort of growth in the value of houses. And that's the graph of Blackwater, which shows much stronger increases in 2010 and 2011. And the median sale price over the last few months, you can see it's starting to level off. It's reached its peak. That's also an interesting graph in relation to the number of houses sold, units sold, and land sold in Blackwater, and you can see that in Blackwater there's also no land. Now in Blackwater, you can see that same graph as I had before with the median sale price, the value of the price of houses following up the median weekly rental. It did follow the coal graph for a while, and it's recently separated from it, but you can see that the rents are starting to turn at the top now, so we're in the correction phase. Moranbah, this one really shows you the story. This is what happens. If you have a look at the top, where the median rental in weekly rental in Moranbah reached $2,025 a week, that graph shows at the end of quarter 2 2012, they would fall back to $1,425. I can tell you that today it is probably $750 if you can rent. There's 260 houses in the housing pool, and that blue line of the average median price has come off by about $150,000 in the last 3 months. That's what happens when things sort of get out of control. That's the correction that had to happen. It was a train wreck waiting to happen, and there will be people who will burn their fingers really badly. However, time says we'll see it all again. History tells us that we will see that again. Okay, from my analysis, I think that the housing values are affected by 2 factors in relation to the mining industry. They're impacted by increasing production and increasing coal prices. The increasing production side generally results in steady growth and see steady growth in the towns. Increasing coal prices leads to higher levels of investment in exploration and new projects which drive significantly increased demand for labour and as a result housing and accommodation. And that's where the demand comes from. So if you watch the coal price is pretty much going to tell you exactly what's going on. Current issues for coal production are the current coal price and the high Australian dollar. The uncertainty in the current demand due to the US elections. Change of leadership in China, I think, is a major factor. Increasing production costs, employment condition disputes, a move towards natural gas. I can't get the updated ABARE figures, but that's the graph of production and volume and value from thermal coal up till the end of the 2011-2012 financial year, and also for metallurgical coals, which show that there's been a strong growth. Now, if you can put the tail on that graph now, that's what it looks like. So that's the graph of the thermal coal price in Australia since 2002, so that's 10 years. And you can see the spike in 2008, which measures up against the spike in real estate values. But we've had real estate values increasing and the coal price dropping, so something's been going on. So in my view, the housing market's most severely impacted when coal prices are high and investment in exploration and mine development increases. The same goes for accommodation in general rather than just housing. The availability of ready-to-go land for housing development is generally poor when these periods occur, and we see it time after time. And investor confidence in the financial sector sentiment restricts development pipelines in anticipation of the next investment spike. So when things are quiet, we don't have any activity at all. When things are ready to go, everything needs to be done tomorrow. What happens is that we get significant rental property shortages during lag time and leads to those spikes. And when the imbalance corrects, values stabilise as you can see from 2006 to 2010 in Emerald, where there was a stabilisation after a rapid increase and going through those spikes between 2002 and 2005. The other thing that came up, one of my training valuers actually did their thesis on the mix of housing within mining towns and the impact on value. And what she came up with was that in general terms, most of the towns in the mining areas are undersupplied with high density housing by comparison with overall average. And I think that also shows its way through, although I think in Emerald we're just about to correct that. So just in terms of what I think the mix was, I can't attach too much confidence to these numbers, though the best statistical analysis I could do with the resources I had available was that in Emerald there were roughly 4,000 houses and 1,000 units and flats, and in Blackwater there was 2,400 houses and 100 units and flats. It probably goes to show that in a place like Blackwater there's a need for more medium density housing, high density housing. The data generally indicates, as I said, that Emerald's better able to withstand the accommodation shortages because it has a better mix of more affordable accommodation, and that's happened over the last few years. As I said before, there's relatively strong evidence that we need to put a higher emphasis on higher density developments in the coalfield towns. Developments need to be placed close to community hubs due to a lack of public transport. Now, I think this is a pretty important issue and something that people need to start to think about. I was in Mackay the other day, and I go to Mackay periodically, but I couldn't find a car park within about 5 blocks of where I wanted to be in Mackay the other day. All the public car parks are full, couldn't find a meter. And what's the problem? Why is that the case? The case is that Mackay's sort of growing pretty much like we have, but they've never factored in a public transport system into their planning so that people can leave their cars at home. And I think that's something that I see going forward, that if we're going to build high density housing, it needs to be close to the centre of town. There has been a big upturn in the number of units that have been approved for development in Emerald, and I think that'll go some way towards dealing with some of the issues that we've identified. There were strong sales of those units off the plan until about June 2012, and at the present time the demand is currently sluggish for unbuilt product. What we're seeing at the moment coming back into the market is less investors and more owner-occupiers, and owner-occupiers look for built product, not unbuilt product. So I think that's just a little bit of a trend. I don't know what will happen now that the first homeowner scheme stuff has changed around again, whether that will change. There's been a significant upturn in approvals and applications for short-term accommodation. Now, my research just of late tells me that there's applications on the books or approved by council in Emerald for in excess of 700 motel rooms. I don't know what's going to happen there. I don't know that currently the economy can handle that. I did have some statistics a few years ago that mapped the number of motel rooms in Emerald against the arrivals at the Emerald Airport, and up until 2008 they rose pretty much in line, but the increase in motel rooms increased at the same rate as the number of motel rooms in town. So between 2000 and 2008 the number of arrivals at the Emerald Airport roughly doubled, and the number of motel rooms in Emerald roughly doubled. They've got all out of kilter in the last 4 or 5 years, so there definitely is a need for more motel rooms, but I don't know whether there's demand for 700 plus of them. There's strong investment demand for all forms of short-term accommodation, both existing and undeveloped, and we've probably seen the movement of some of the major players now into the workers' camp accommodation. Companies like Mac are looking to expand, and crews like Discovery, who own the Discovery Parks and that sort of stuff, have started now to invest in workers' accommodation, which is an interesting trend. And vacant residential land has been progressively completed, ready for housing construction since about March 2012, which I think has taken a fair bit of pressure off the market. Those of you who've been to a previous conference that I presented to will have seen what I think should be improved going forward, and that is that master planning of future development precincts I think needs to happen. There needs to be more strong partnerships between the players in the game to have land shovel ready, if you like, so that when things start to change, that maybe it should be included in the EISs and impact statements for new mines, that they have to have a land pool ready, available. The encouragement of innovation in housing construction to reduce cost, and the willingness by resource companies to invest in housing when market failure occurs. And as I said before, I don't think it's about housing, it's about land. Private enterprise will look after it if the land's available. In relation to other property, values in commercial and industrial properties have been increasing at an average rate since about 2006. What I mean by that is they've been increasing at a steady rate. By comparison with other places, they've been increasing above average. And I think I've gone on and said that in that next point. Commercial and industrial rents are in realistic relativity with the major regional centres in this area of Mackay, Rockhampton and Gladstone, but I will say that they are more expensive than places like Townsville and Brisbane in terms of industrial rents. So that's just something to keep an eye on in terms of the relativity. And to me, there appears to be sufficient industrial land available to meet needs for the foreseeable future. Just a couple of other little interesting asides. I'm not really sure what the impact of the new shopping centre will be at this point on the value of other commercial property in town. I'm pretty positive about the effect it will have. I think I'm hopeful that it retains more dollars in town and has a spin-off to other businesses in town by those dollars not leaving town. And I definitely think that the other thing is that there are a lot more people from the west now coming here to shop since that shopping centre was built. It could have an interesting spin-off for accommodation providers in terms of bolstering their weekend occupancies, which have traditionally been very poor. The other thing that I think is interesting is that Emerald over the last 10 years has certainly developed as more of a mining industry hub, and I think it offers us a lot more protection than what we had 10 or 15 years ago against significant downturns in the mining industry. The fact that that industry is now there on the industrial estate and the shopping centre is there provides us, I think, with a wider employment base, which should take to some, should even out the peaks and troughs which we see when the mining industry has a blip. And there's a lot of people in this room that were here in between 1998 and 2002 and know that the longer the downturn went on, the worse it got. And I think that that's probably the trick at the moment. The longer it goes on, the more we'll see the effects. But I think that the diversification in the employment base in the town, both through the new shopping centres and the industries that have established, will help to Emerald to ride through a little better than it has in the past. I think that there are a couple of the things, as I said, the severity and length of the current downturn in coal prices will determine what happens. And the other thing is that there's a very strong increase in the number of units and investment houses in the Emerald market, which are largely under construction. I think that that will do some stuff in relation to holding rents at reasonable levels. So that's that from me. Thank you. I don't know, I guess it doesn't look like.
I hope this comes back on. Yeah, we'll have to wait for those tips for later.
Yeah, I know it's not important.
Thank you very much, Pat. Obviously, there's a whole heap of things going on there, and I mean, as I said to you, if you want to write some of these things down statistically, you know, Pat's shown some real anomalies there with some of the figures we've seen earlier. So it's no wonder that I guess our council at the moment is obviously working on some strategic framework stuff that I guess takes into account all those factors. It's a very difficult job, and I actually acknowledge those councillors here today. I think our Mayor Peter Maguire here today, Deputy Mayor Gail Nixon, Councillor Peter Mondrell, Councillor Gay Cypher, Councillor Paul Bell, and I hope no one else has snuck in. No? And I mean, that is a very, very difficult task they're going through at the moment. Those people are obviously having to consider those factors, and I mean, there's some, you know, some figures and some numbers and some trends there that really define logic in a traditional sense. I think, James, you'd probably agree with that. And those sorts of things make it very, very difficult to then say, historically, what then becomes a pattern for what we want to do versus, you know, actually meeting the challenges that are actually here, and the fact that that fluidity is actually changing on almost a 6-monthly basis. And Pat says you'll see some figures that go off the end of his graphs that will actually change some things again. So you'll see some trends change there. Well, look, our third speaker today perhaps might broaden our horizons a little more past just our streets here in our region. Daryl Conroy, who I haven't had the opportunity of meeting this morning while I was doing my IT stuff over there with the speakers. Daryl's company obviously has a very, very prominent position in our banking community in Emerald at Suncorp. Daryl has had over 15 years experience in the field of finance and treasury. He's Suncorp's bank's financial market analyst, and obviously given the two previous speakers, that's a busy job at the moment. But certainly within international trade and finance markets. So I mean, obviously those horizons are a little longer, and he's trying to see those trends as they apply to this area here. Been with Suncorp since 2004, so he's been there in a very exciting period of time, seen some ups and downs. Daryl keeps Suncorp's business, customers and staffs up to date on market trends and economic analysis on interest rates, foreign exchange and commodity markets, which are very relevant to a lot of forward marketers in our community. Could you please welcome Daryl Conroy?
Good morning, folks. Thank you for that rather salubrious introduction. Makes me feel intelligent when I hear those sort of things. But what I'm going to attempt to do this morning for you is just, I guess, run through some of the influences, some of the factors that are occurring at a bit of a global and a domestic level, and of course how some of those may well filter down to regional areas such as Emerald, and hopefully I can just draw on some of those issues that Pat has also alluded to and give a little extra flavour and a bit of colour to those. So without further ado, thank you, Pat. Okay, now you've got a obviously this economy is also going through its challenges, its change, its fast growth. There's a lot to digest there, and to be honest, no different to what's going on around the global scene, no different, especially at a domestic or a national level in Australia. Very, very similar things being digested and working their way through those respective economies. And one of the big factors at that very high level is this notion of change. It just continues to come through in waves. Some of these are pretty subtle, i.e. a bit of a power shift from the west to the east. Others not quite as subtle, such as Australia's trade with Asia and predominantly China. You know, we're really very much in lockstep with that economy. As we've heard, you know, you can track your house prices and rentals here very, very closely with respect to one commodity, and that's quite amazing. So, you know, these things are going to continue. What we are seeing is a lot of stop-start sort of stuff. You know, these long, slow trends seem to have been replaced by a lot more, you know, we're going great, we're going terrible, we're going great, going terrible. So we're just going to see a continuation of that. This is creating uncertainty. It means businesses do struggle to, I guess, muster up that courage to say, okay, do I borrow, do I invest, do I get out there and risk capital? And everyone's just sort of sitting on the fence there to a degree, waiting. Let's just wait till things settle down, wait till things get better. What has it been now? About 5 years since the technical GFC. Have we returned to normal? Certainly not. There's a couple of no's from the front here. So it is an environment which is, I think, just going to be plagued by this continual level of uncertainty and a bit of a shifting sands under the feet. So something, instead of, I guess, bunkering down and saying, okay, let's ride out this storm and wait for it to pass, we're going to have to get a bit more aggressive, get out there on that front foot and say, okay, well, if the environment's going to be uncertain, there's going to be a continuation of bad news, what do I need to do, what can I do to continue to create more certainty and business custom for your own businesses? Oh, financial services, it's great, isn't it? Compliance. Don't believe a word I say, I don't get paid anywhere near enough. Okay, the big three. Now again, this I guess falls into that notion of uncertainty. It's just not going away, unfortunately. These three here, and Pat alluded to the US elections. That presidential election over the US, it's a wonderful fanfare, but just past that, elections are in November. At the end of the year, or the January of the following year, we've got something called the fiscal cliff for the US. And that's going to be something akin to what I guess the Europeans have experienced, harsh austerity measures. Because we've got something like $500 billion US, which is essentially going to come out of that economy. Now, whether that be the cessation of tax breaks or cutting back spending, either way, it's money not going to be circulating into that US economy. And it's an enormous amount, and it's going to have quite a big influence and impact on that market. How it's going to pan out, well, we certainly can hypothesise that, but we do have to wait and see to a degree how well it's managed, how they manage this. But it is a big one for the US. Once we get past this circus being the elections, it is going to be a large one. Our friends in Europe, yeah, unfortunately, again, it's going to be the stop-start. There's no solutions coming to the fore there. It's all about, I guess, greasing the wheels for the financial system, kicking the can down the road, so to speak. You've probably heard that term in the financial press. What they're trying to buy some time to rebuild and repair their systems. The monetary system, the banking system, are all under high, extreme stress, I should say. And this is going to take a lot of time to work its way through the system. So, again, no real good news there. We're just going to see that continuation of, Greece is fine, Greece is terrible, Spain's fine, Spain's terrible, Portugal. So, a continuation of this operating in, we're not going to shoot out the lights, nor should we fall off a cliff, but we're just going to continue to go up and down. Our friends in China, we're watching those guys much more closely now, of course. That's our biggest trading partner here in Australia. And of course, as Pat was alluding to there with, monitoring coal prices, looking at their elections as well. Not so much elections, but it's handover of power. And of course, that's going to occur in a pretty similar time frame to our friends in the US. But under that, and why we're having, a real lack of decision-making and action in China, due to their really sharp downturn, is that, people are jostling more for power and trying to make their way and find their positions rather than worrying about what's their economy doing and what are some of the long-term impacts going to be. With respect to government spending, they've made some plans to inject some money, capital, and get things moving over in China, but to date nothing's really been spent, so it's just sort of shuffling the papers until they can get a new government and settle themselves on a political footing. So unfortunately from those big three, the continuation of this uncertainty, unfortunately. Now change, certainly that's been a bit of a topic today. With high growth comes the challenges of change and managing high growth. It's probably not too dissimilar to managing low growth because you've got to find ways to cope and mechanisms. Now all areas are really being challenged as a result of this. Here in Australia, of course, we've got government sectors being challenged, and of course they've got some pretty hefty deficits on balance sheets. So what we're seeing there is a contraction in spending in Australia as well. And that's pretty much across all three levels of government. Business sector, quite, uncertain again, as I alluded to earlier, risking capital, borrowing, investing. Just prefer to sit on the fence and just see how some things pan out before they go and take that risky step. And of course, it's not a whole lot of fun change, is it? Because it challenges us. We've got to look in the mirror and, how do we deal with it? Usually not terribly well. We change when we're forced to. So, this is something which is evolving and working its way through the system. How do we cope with it all? Well, certainly one thing is going to have to be, the last 20 years or so has been extremely prosperous here in Australia. 20 consecutive years or 21 consecutive years of economic growth. We're certainly trying to get that extra one on the end, but there's some question marks over that. But looking through the windscreen, we're going to have to say, okay, well the last 10 years, 20 years was great. How are we going to prosper? How are we going to achieve goals and continue to perform when looking into the future, and again, with some of the risks that are out there, which we've already alluded to. So I think it's going to be challenging of business models. It's going to be a big one. There was certainly one, I think, released this week, Aquila Resources in the Pilbara saying, well, they can't do what they've done previously, so they've thrown their model up in the air and said, okay, let's rework this. How can we make it work? Iron ore prices have slipped aggressively, as have coal prices. And they're saying, well, we're going to have to remodel this and rejig it. And what they've done is basically added all this third-party servicing for their business and service these mines to make it function and make it function on an economical basis. So We're going to continue to find ways to do things. It's not about falling off a cliff, I don't believe, but we are going to be challenged to think differently, act differently, and find new ways and be a little bit more innovative and productive. Now, I did allude to the world being a little bit sick, that monetary system, the financial system, and probably here's my evidence of that. Does anyone have a problem with that curve? These are interest rates, by the way, for 2-year bonds for Germany, Switzerland and Denmark. And if you can't see it too clearly, there's the zero line just there, and they've all hovered into the negative territory of late. So, you know, this is a sign or a signal from the global financial markets that all is not entirely well, and you know, they're having some problems and ructions there. And of course, a lot of that is about, I guess, within that European Union, is funds moving from the high-risk areas, the gypsies or pigs or whatever you want to call those countries, and moving into the relatively safer markets and areas, the likes of the Swiss markets, the German, French, etc. So, you know, it's still going to be an ongoing issue there. And the fact that we're having to look at negative interest rates is one that really should raise a few alarm bells that all is not entirely well, because when I rustle through my little textbooks to work out what on earth's going on, there's nothing about negative interest rates. So there goes my sum total of knowledge. We have to go and make things up for you. So, you know, it is a really tough environment. We're having to confront ourselves. A year and a half ago, I said to myself, well, interest rates can't go below zero, can they? They can only go so far. Wrong. They've actually gone negative. So, and this is the nature of, I guess, some of the panic in these regions, and also a function of that, I guess, that fear to invest. That rather than invest, rather than borrow, let's just tuck these monies into markets that will guarantee us a negative return. So, for instance, a corporation or an individual might go to one of these markets and say, okay, I'm prepared to give you $100, and in 2 years later get 96 back. So they're losing capital at the end of the day. Now, once you even account for inflation, admittedly it's low, you're even going further backwards. So, you know, this is the nature of the uncertain environment that we're in, and we're just going to have to find ways to navigate it. At the state level, this is the aggregate state budgets, and pretty simple question: why? Why are governments selling assets? Why are they cutting spending? Don't be shy, come on. Essentially, they have to. You know, these budget deficits are almost on record levels. So again, what do we look forward to when we see these sort of things is they're going to be cutting their spending in future periods. They have to repair their balance sheets. But also that nasty word, three-letter word tax starts come to the fore as well. So we're going to have to prepare ourselves for, if we're going to have big holes in budgets, and the federal budget doesn't look too dissimilar to that either, we're going to have to find ways to repair that. And invariably, how does that come about? New taxes. Now, the resources market has certainly been given a bit of a voice today, and you know, it has been a remarkable run-up. And I guess one thing we have to really highlight there is the absolute enormity of it. If we have a look at the previous periods here, this is a commodity price index from our RBA friends, and you know just how big a movement this is. Well and truly, you know, 3 times higher. The media is certainly focusing on this point right here, the downturn in commodity prices, and how, you know, in the world scenarios, but that is still sitting at an enormously high level. When we look at our terms of trade, which is just simply export prices that we receive relative to import prices that we pay, so it's a bit of a function for us of net wealth, national income is a good measure. And now we have to go way past the Korean bull boom back in the 50s and go back to the 1860s, 1880s, I think, even to get a sense of the gold rush era of how big this particular resources boom is. So, and the Boffins in Canberra tell us that, well, you can't have all sectors firing at once. So whilst the resources sector has been big and enormous, and it's been that big that it's grabbed that much more resources, people, capital, money, away from other sectors. So this is why the Aussie economy has been pushed and squeezed so much, because this resources boom has just been so enormous. But very quick to point out there, Pat, that absolutely, you know, these prices have come off the boil, and to be honest, you'd have to say that the mining boom has moved a gear or shifted gear from, you know, that really explosive high demand, high price response, money's been pouring in through investment, etc., and people movement, as we can see in this region. And now we shift to a gear of, okay, well, a lot of that has now occurred. There's been a lot of construction, so we're now going to move from that high price and that price volatility section now to more about the volume game and trying to shift more product. So what we lose in the price side of things, coming off the boil, we'll partly offset that with some higher volumes. But also with mines moving from that construction to production phase, less people are required, and that's going to have some regional influences as well. And gas is probably not as relevant here obviously, but it certainly is one which is a pretty big impact, because through the construction phase you might have about 15 to 20 people versus one person to run it between construction and production. So it's a very big impact there, and hopefully you get a sense of the size of that. But here's our challenge in Australia. If mining and resources are coming off the boil, what's going to pick up the slack? Consumption, consumers, yeah, they're still fairly heavily indebted, so their hands are tied somewhat, they're fairly constrained. Governments, as I've alluded to, have got a few holes in their buckets and they're trying to fill those, so where else does that leave? It still leaves another broader business sector for investment in business, but that non-mining part of the Aussie economy has been battered of late, and it has dwindled to a degree. So we're expecting an uplift from the non-mining or non-resources sector of our economy here in Australia, but it's certainly going to be a challenge, and that's why we are seeing the likes of the Aussie dollar come off the boil, primarily because of those two factors, commodities and our terms of trade falling. But I guess that relief measure or lever is going to come from interest rates from our friends at the RBA, as they're trying to make sure we do have somewhat of a balanced economy. And if one sector, which is enormous, is slowing, then they're going to have to find some other areas to fill a void, and certainly interest rates will come off the boil as a result. Bank funding, yeah, this is a curly one. I'm not usually allowed outside the room without talking about this one. Now, it's certainly not a pleasant story for a part of the economy, which is, of course, borrowers. Because what we have had, I should use my little clicker here, funding costs have jacked up post-GFC. What have lending rates done? Mirrored it. So, and we get I guess there's a lot of commentary and hyperbole and a lot of nonsense out there in the marketplace, and I have to say that, banks are bastards is one of those, but if you look at margins that banks are extracting, and we look over a 10-year basis, that average is coming down. There was a bit of a response there post-GFC, but that has been a downward move. So I'm trying to give a little bit of balance to that story. And if we actually have a look at these margins between funding and lending rates, we had about a 300-point differential early on in the century in 2000. That narrowed quite significantly leading up to the GFC. And funnily enough, the RBA at that time were warning the bell, saying, "Hey, this is a good party, people, but are you appropriately pricing for risk?" And the answer to that was clearly no. So they have narrowed, and they're just starting to expand again. So to a degree, we've only just turned back the clock and gone back to normal. So yes, banks don't pass on the full margin when we get these RBA rate changes. There's a whole bit of a cocktail there with respect to bank balance sheets, but ultimately banks don't fund themselves on the cash rate. So the cash rate is a measure and a mechanism to change behaviours and change the money supply here in Australia. It has nothing to do directly with lending rates, and the relationship between the two has broken down a bit. So what am I trying to say there? Am I trying to excuse the banks? No. I'm just trying to highlight to you that we're going to see more and more of those behaviours going forward as we get some of these pressures continue to wind down. So we're going to see more of that issue going forward, unfortunately. But it's only part of the story, because our friends at the RBA, through the Hilda research, tell us that, well, of householders and home and those home occupiers, only 30% have mortgages. So that leaves renters and I guess owners who own their homes outright that actually would prefer the interest rates to be higher on the other foot and moving higher, because those on fixed incomes, retirees, etc., really are suffering under lower interest rates. So whilst there's a cheer in the press for the likes of lower rates, the flip side is that those on fixed incomes are hurting. So what we have seen is effectively post-GFC is those borrowers are losing under higher margins. The flip side is depositors are winning under those exact same movements. So that's, I guess, another one of those factors we're going to have to get accustomed to going forward. Another one I do want to highlight is the whole notion, the two-speed, the patchwork economy here in Australia, and indeed your regional economy as well. And we get a lot about the bad news cycle. This stuff hits us every day, and we can't escape it, whether it's bad news coming from overseas, bad news coming domestically, bad news coming regionally. But this isn't going to go away. This is going to sell newspapers day in, day out. So I guess from a business perspective, we have to somehow transfer this negative sentiment across to a more positive sentiment, because growth brings opportunities, etc. So we have to find ways to continue to operate, navigate, do things a little more cleverly, and operate that a little bit better. And those factors down that right-hand column are going to continue to drive, I think, performance in the next 5 or 10 years or so. And one I do want to spend just a little bit of time on is technology. You'd have to argue that what we're experiencing right now would have to be a technological or a digital revolution. It is changing the way we do business that significantly, that greatly. You know, the internet back in the late 90s was a big thing. The NASDAQ crashed. It turned out to be not much, but guess what? There's a lot of business being done now through consumers, through business to business, through the internet. Digital media is absolutely exploding, and it's going to change the way we do things. Would be a couple of good examples there. A couple of anecdotes for you would have to be, I guess, that retail sector. Bricks and mortar, you know, those businesses are starting to struggle, bricks and mortar retail, especially in metro areas. However, some of those more online businesses really are experiencing exceptional growth and very, very exciting times and good profits. So, you know, there's a big change, I guess, we're going through, and it's going to continue to change the way we do things. Just because something's worked wonderfully well through in the last 5 or 10 years doesn't necessarily mean it can be replicated in the next 5 to 10. So we have to keep thinking about how we operate, navigate and succeed for that next 5 years. And my colour scheme isn't terribly flash there, but hopefully the rolling hills give you some excitement. These are probably a couple of the sectors which are going to take this region and the Australian economy through to the next 10 or 20 years. Food, water and energy, very, very big factors, and certainly not going away. So there'll be a lot more said, done, invested, money made, lost in those sectors going forward. I don't want to give you all bad news. There has to be some good news there as well, doesn't there? Okay, financial markets. I'm supposed to know something or two about those, so what can I give you with respect to those? Anyone going to offer to come up and give me a bit of help there at all? No? Didn't think so. Okay, cash is king. You know, we are seeing negative rates because people are worried, concerned, and obviously money's going into, I guess, a more short-term measure, a safer measure where they feel as though they've got more control and less exposure to capital loss. However, in the likes of our friends in Germany, Switzerland, etc., you can't keep those funds there forever because you're going backwards. So what we have seen in Australia is a lot of these global investors saying, okay, well, zero rates or even indeed negative rates overseas, let's go and invest in a place like Australia. It's relatively safe, stable, it's got one of these AAA ratings, which are as rare as hen's teeth now, and interest rates are relatively higher. Yes, they are forecast to change and fall a bit over coming periods, but you know, this has been a massive inflow of investment into Australia, which has led to historical low interest rates, and it has also had a currency impact here in Australia as well. So this has been a big one for us. And that's obviously affected our borrowing rates to be very exciting. Yes, absolutely. Interest rates are forecast to continue to decrease. And I don't know really why that's there actually. I'll try and work that one out. Looking at markets is a bit, you know, which way are we going? And this picture, we've either got a chap with a turban or a lady with a scarf on. Which one is it? You know, I'm trying to highlight the two sides of markets, the two sides of the currency, the two sides of interest rates. There's always a winner and a loser on each side. There's always a positive and negative. So again, you know, change is confronting, it is challenging, but we're going to have to continue to work it through. That was bizarre, wasn't it? Okay, the cash rate, yes, it is forecast to continue to slide. Markets are aggressively pricing one more cut this year, and they're pinning that at about a 90% chance per the futures markets. And if you look into next year, they're getting really, really excited, suggesting something the cash rate will slip below 2.5%. And before you jump up and down for joy, the flip side, of course, is depositors, investors who aren't terribly happy about that. But it's also the fact that they're cutting for a reason. Now, you know, if economy's growing and improving and you know, you've got positive growth, you're likely to have stable or slightly increasing rates. So it is a bit of a warning bell there. Having said that, though, futures markets perennially get a little bit overexcited about things. They overprice and underprice, and certainly we believe they are overpricing the risk of cash rate cuts into next year, because that is extremely aggressive and would have us well and truly into historical record lows for our cash rate, whilst we've still got some very big positives in our economy. So yes, the cash rate is likely to ease going forward. However, we just don't believe it's going to be as fast and sharp as what markets are currently pricing, per the futures markets anyway. And yes, we've got a historical low here in our long-term rates, and the 10-year bond rate is one of those. It's just snuck up a bit higher than that of late. However, it does provide and should provide opportunities for borrowers to lock in lower rates. The rates are likely to be lower for longer as we continue down this downward cycle. However, what we do see generally is fixed rates will pop up much quicker than when the cash rate actually increases. So sitting there waiting for that absolute bottom rate could cost you in the long run. So certainly be mindful of the fact that it will change going forward. Aussie dollar, good news, it's overvalued. What a cheering too loudly here, they're a bit of a quiet bunch. Okay, well the Aussie dollar, it has moved away from commodity prices, and we have seen a bit of a, it's a strong relationship between the two, so we should see a bit of a correction there. We think some of our commodities will increase a bit, and we do believe the Aussie will come off in line with lower rates here in Australia, etc. House prices, I'm not even going to go there, the experts have spoken. And I just want to leave you with a thought there from our friend Winston Churchill, and it's just, there's two sides to every coin. We have to just keep finding that positive, keep working through there are many opportunities, there are risks here in the globe, in Australia, however, we've just got to find and continue to needle our way to look at the positive and find some successes going forward. So that's it from me, folks.
Right, well, thank you very much, Daryl. I guess we put up a little bit of time. Now, the glitch at the start means that this microphone that I have in my hand is the only one that works. So I guess if there are people that have a question in the room, I'm going to actually have to ask you to actually perhaps stand up in your place and yell out your question. But what I'll do is, our speakers are obviously here at the front, but if you have a question for any of those speakers, we'll run through that. And obviously, as I said earlier, James feeds into Pat, feeds into Daryl. So I guess sitting down there and trying to take some notes, it becomes very clear that I guess if you came into this room with some perceptions of how things are, you possibly had them changed, you possibly had them reinforced, but I guess you probably all had them added to substantially. The challenge for all of us, and if we need to walk out of here with the result, is how we're going to go forward with some of those things. And those are the questions that are posed to you today. You can see through some of those presentations that there are people obviously considering the options that this community has, and council and CHDC are considering those options, and probably trying to make this group as informed as it possibly can, so that I guess at the end of the day you can walk out of here and say there is a comfortable I guess group of people making sure that they've got their finger right on exactly what is happening in our community, wrapped around what is happening broadly, and feeding into those very day-to-day things that we're all actually trying to deal with simply some of those figures that Pat had in his presentation. So if there's a burning question that any of you have, we'll do that now. We've got about 10 minutes to talk to some of those speakers. No, I said it's really important if you don't, obviously stay around, catch up with James and Pat and Daryl, but if anyone has a question from the room. Yeah, Steve Taylor, yep.
Question for Daryl. Could you explain a little bit further what's going to trigger the events in the US early next year?
Okay, well those events that I was alluding to, yeah, with respect to the budgeted cuts from spending cuts, well they're actually legislated. The US Congress they weren't mature enough to come to a sensible agreement. Does that sound familiar? So unfortunately they then had to go to the next step, which was basically, okay, if you can't sensibly sit down and agree and nut out a plan, then the legislature comes into play, and they've come up with a figure of 500 billion, and that's only next year. I believe that'll then be replicated next year as well. So that's a legislated measure. It will occur rain, hail or shine. So the big question is how they manage and how they deal with that situation, more so than will it occur. Does that answer your question? Yeah. Excellent.
We'll just hang about here. James can come up too. And I guess, from that, Steve, obviously the change to the US economy means consumerism obviously drops off, which has that double-headed arrow effect with China and production and manufacturing. So I guess absolutely. So I guess that's the result. The old two-headed arrow. It's a very good indicative situation there, but that's what happened. So obviously that slowdown in China, particularly with the manufacturing side, affects, I guess, a feed down or a trickle down effect. That's the buzzword now, isn't it? The trickle down. Other questions? Yeah, Carl Morowitz.
Director Daryl, your negative interest rate factor between big three, as you showed them, is that somewhat indicative of the fact that those same big three are heavily investing in gold, which bears no interest? And how do you see that affecting currency 3-5 years out? Do you envision a gold-based currency move by any way?
Yeah, obviously you've been around a while, Carl, because here's a pretty sad fact that not one currency has ever survived indefinitely. So they've all come and gone and roared through, whether it be the Asian currencies, whether it be the Europeans, the UK, the US, they've all come and gone over time. the one constant has been gold. And of course, through these times of uncertainty and the likes of negative interest rates, people are investing in sectors and areas where they think, okay, well, what's an alternative? If the financial securities market and financial services seems to be a bit unsettled, where can we go? Well, cash is obviously one, but gold certainly is another. Hence, there's been a massive run up in the gold price. Sadly, I didn't have a chart for that, but it has been very, very extreme with the other precious metals as well. And yes, there has been some pretty heavy activity within that market, and some countries certainly preferring not to hold things like currencies, like US dollars, preferring to hold some precious metals as a store of wealth or value in a concern. From an investor's point of view, we're probably seeing something like investment portfolios saying, well, I'm just going to have a small allocation to this sector, so allocate something like 10% to gold as a bit of an insurance against the worst happening into the future. Your time frame there, Carl, 3 to 5 years out, it's a bit much for me. I'm not quite that smart, sadly, but the likes of zero interest rates and indeed negative bond yields in some countries, especially Europe, is creating these forces and generating a lot of activity and some shifting there away from certain assets and asset classes. So we're going to continue to see that. It's also having a currency effect. It's called currency wars in the marketplace. Certainly the US policies is driving their currency and their interest rates lower, but that's it. Currencies are measured as a bit of a flip side. So you don't just talk about an Aussie dollar, you talk about an Aussie US dollar, which means if the US dollar is falling, by definition, we're rising. So the event in the US, if that does create more instability and a bit of chaos over there, I'm not saying it will, but if it does go to that, we might see that US dollar fall a bit further, which by definition pushes our currency up that little bit higher. So it is creating these, I guess, fractures within this global financial system, and certainly precious metals and currencies are two big ones. And that's being experienced in. Some investors just don't want to hold US dollars, moving away, so they prefer to hold either other currencies or precious metals such as gold. Does that answer your question, Carl? Part of it. Grab me afterwards, Mal. Let's see how we go.
It's not Parliament, Carl. You don't get the supplementary, mate. You'll have to get that afterwards. Any other questions? Fire away. That's been fairly big picture stuff. Is there any more on a local level? Yeah. Grant's back.
Question for Pat. You didn't mention any impact of the 08 and 2010-11 floods on your real estate trends in Adelaide.
There's nothing there. You can't see it. But what I will tell you is that in the last 4 to 5 months, that the price of flooded houses has fallen, and I think that can be directly sheeted back to the increase in insurance premiums. So it's been especially noticeable over the last few months that has actually occurred. But otherwise, at the time of the floods, nothing. What I was surprised about at the time after the 2010 flood was how quickly the price of houses increased again, of flooded houses increased again after the event. But as I said, in recent times the increase in insurance premiums has taken the gloss off them and turned a lot of investors away from flooded houses.
Any other questions? Well,
yeah, I think maybe James and Gerald might be able to help, but when I look at sort of last year's, I suppose, figures for Australia in regards to production, I think iron ore come in at about 90 billion, coal come in at about 55 billion. In between that, though, was Australian bonds, which was our second biggest sector of trade last year. I still am confused now about what that's going to do to our Australian dollar, and I think it's an amazing reflection on European money and other money coming in here. And if we are looking at restoring our traditional industries of tourism, agriculture, particularly, I just think that we have still got some long ways to go. If that uncertainty in Europe is going to continue to see strong investment into Australia and certainly, I think, affecting our dollar, which we need to be a lot lower than what it is. James, would
I can speak at least from the tourism perspective. Certainly, as you highlighted there, the nature of global markets has significantly affected the modus operandi for business in Australia. That's affected trends. That's affected affected visitation. That's affected the way that, from a tourism perspective, at least we need to target our marketing efforts. And the typical tourist has changed. From a local business perspective, there are certain things that you have control over, and there are certain things that you don't, unfortunately. And when it comes down to that local level, it's about recognising that this uncertainty is going to continue for a degree, at least from what we've heard. And as we've heard already from Daryl, but certainly in terms of kicking the can down the road a little bit further, it's going to be about trying to see how we can continue to just put off some of the longer term concerns, but the underlying fundamentals there are still concerning, and the Australian economy is still an appealing place to put your money, which means we're going to continue to have a strong Australian development for a degree. Though that's only what I'm reading, that's not a KPMG opinion. So look, it means that there is a need for businesses to adapt, and that's what we've had to see over the last few years at least. And it's going to continue to be a challenge. Can't afford that pass.
Yeah, thanks, James. Yeah, certainly the influence, absolutely. You know, investors flocking into Australia means it pushes down our bond yields to record levels, and it pushes up our currency, not to record levels, but very, very, very high levels. And it certainly has sustained that. But normally we see our currency, and much like Pat alluded to with house prices and rentals following the coal price, normally our currency will more closely follow commodity price movements and those trails, and it certainly has tapered down. Aussie dollar hasn't really done that, and that's because of this influence of the size of this investment coming in from abroad. And that's from speculative investors, it's coming from central banks from abroad, so they can get a higher yield. It's pushing our currency higher, it's widening the gap between the two, and as Pat's alluded to with his discussion about property prices and commodity prices, at some point they'll have to come back together. Now, I can't say exactly which way that's going to go, I'm not that smart, but we probably might see a little bit of both, to be honest. But certainly we do expect, as our terms of trade and our commodities continue to soften, our dollar's going to continue just to tick down. The problem with overseas investment, and we've seen this with the Asian crisis, the Mexican bond crisis, the Argentine bond crisis, the Russian bond crisis, guess what happens? Investors trickle in, and then when an event occurs, they exit very, very quickly, and of course that could then have very big, sharp connotations for the likes of our Aussie dollar and also our bond prices as well. So whilst I'm not advocating that, it's just one of those risks you've got to put in the back of your mind, a bit of what if, and if the investor pool's that big, and if that's the top three here in Australia, that's how significant it is in a very small little economy, the ramifications are it's probably going to lead to more volatility going forward. But certainly we are seeing a softening in that Aussie dollar and can continue to expect to see that evolve.
More questions? Yeah, you got
Anthony Comno, yep.
You've got three countries, USA is another country, and you've got China. USA has got the biggest gold reserve in the world and buying gold at the moment like a man with no arms. You've got a country that's broke. How do they buy this gold? And China's trying to catch them, and there's someone in the middle, I can't remember who that was. How does that happen?
Yeah, there's a number of, and looking at, you can actually look those up, those gold reserves in some of the websites, so it's quite fascinating to see, and certainly more recently the activity in it, the last couple of years, has been very, very interesting. Everyone wants to hold some sort of a store of value, and this is one way of taking out some insurance against the reserve currency of the world. It is still the most traded, it is still recognised as that reserve status in the world, the US dollar, but there's just more and more doubts creeping in, so gold becomes that much more an important commodity to trade and hold, because it has that historical store of value. It's the one thing that stood that test of time, and I can only see that continuing whilst we have these policies. As James, we're kicking that can down the road, having these ridiculously low interest rates, it's just going to continue to exacerbate some of these stresses and pressures.
USA being so broke, how can they afford to buy it? What do they buy it with?
They just print the money.
That's easy, US dollars. They get to print them. It may not have a value at the end of the day, so they'll hold something with value. That's a little facetious on my part, but this whole concept of money printing is starting to become very commonplace throughout the globe, and it is creating these pressures, fractures, and stresses. And when I guess you hold the keys to the printing press, it's not too hard, is it?
They've got the gold, and someone's got paperless money.
Yes, and there's a lot of derivative products, etc., that come off the back of that, which is that going to be the next little I guess incident and bubble we have to deal with in time to come? Possibly.
Look, we might just wrap it up there, and I'll just, you speakers, if you wouldn't mind, just to thank them if you'll stay there. I just did it using my iPad here, of course. Jotted a few things down here this morning that they spoke about James on the end there. I think it is coming through pretty clearly now that obviously in this room confidence is a big thing, and obviously with the bad news cycle that I think we referred to a couple of times here today, whilst it's not all bad news, it's about the confidence part of that that's actually good to catch up on here today, and obviously some people thinking pretty big about the shuffle down and the trickle down from that. James talked about the fact that this region will reach a population of 50,000 if the trends stay the same by 2031, so I guess there's some really interesting issues with dealing with that. Very interesting about our community here is now a very multinational community, multicultural and multinational, but very multicultural. I think that was a surprise that came through those ABS statistics that a lot of Australians that we have in our community whose parents were particularly born overseas is a significant percentage. So we actually have, and that's something that we are going to have to adapt to. There's a strong growth in young families here. I think a lot of us are aware of that. A strong male workforce, I think that follows pretty well as well. Probably confusing was the diminishing school age, the number of children. That was an interesting point that came up in there. And obviously the fact that we do earn a lot of money here is quite interesting and creates, obviously for those people that earn it, good luck to you. But for those that don't, it creates some interesting problems. Pat was very specific about our market here at Emerald. It's probably not everything, I guess, to everyone, but I mean it is a very important indicator for this community. It's been something that growth always brings. So to look at some of those figures, the correlations between some actual figures and trends particularly was very interesting, particularly the levelling off. I think there's, in a time of heightened activity, there's always an assumption that perhaps things are escalating at significantly higher prices, and you showed sort of the difference between places like Moranbah here and the likely outcome of some corrections. So I guess that was a little bit confronting as well. And the fact that between 2006 and 2012, steady prices really for units and land here, and people would have assumed there was an incrementally great rise in the price. So that was pretty interesting. And I like the Paul Keating line there, the correction that had to happen. Obviously Darryl spoke there at the end, and I'm pleased that he left that visual there for you, and it's obviously quite fitting, I think, that I think pretty much we're all optimists, and we like to think that there's opportunity. So I guess whilst a lot of the discussion today was about the impact that one commodity has on lots of things and trends that happen here, the reality is there are other opportunities and we should be focusing on them, and people are taking those challenges. And that word that came through when Darryl's talked there about thinking and acting differently, we are certainly going to have to do that. And that patchwork economy, I think, which we are aware of, but I think we all sit back and look at what RBA and others are doing and wondering, there's obviously there used to be 2 levers in that big building, and now there's several levers, and you just wonder whether or not the people are qualified to deal with more than 2. But I mean, the reality is, who are we pulling the levers for? Which part of the economy is changing? And sure, a lot of our retail has been based on consumerism. That's changing, and there's some interesting challenges there. And of course, food, water, and energy. They're the big 3 things that we probably have here, and they're obviously going to be changing. So, look, ladies and gentlemen, that's just a few brief notes that I took. Obviously, you've taken away some other things, but could you please thank our speakers, James Matthews, Pat Lyons, Scott Conroy. If you gentlemen can take something else. I know it's just like a bull sale, you sell pretty well. No disrespect to the other 2, but Pat, you sell pretty well. Thanks, everyone likes a little thick Angus bull. Now there's some homework I've got to do here at the end here. Look, I've got to thank our sponsors again. Qantas Link, make sure that all our guest speakers get here. Central Highlands Autos, always make sure they sponsor this breakfast the last few years, last few months, and particularly up till now. We can't do these things without those support. People have got to give us some real money, and we appreciate that very, very much. Can I also thank Liz and her wonderful staff here at the Emerald Explorers Inn. We haven't been here for a while. Could you please give them a big round of applause, please? It's a bit of a shock to the system when you have to get up at 5:30 and start preparing for 75 or 80 really, really hungry people. Now, can I thank also the CHDC staff? I mean, these things don't happen without the energy and the vibrancy that you need to keep these things going. Sandra Hobbs leads a wonderful team down here. Elena Garnsworth is hiding in here in the corner. Liana Panisi, who is actually going to her brother's wedding today, has left about 8 o'clock. You may have seen Alana having kittens here about this PA system. She's a wonderful new talent at CHDC, and she's not here, but we thank her very much for her efforts in preparing this day. Shay's here as well. And also that young man from the kitchen that actually fixed the speaker. We love him very much. And he's just so laid back. That's great. Look, thank you all very much for attending. Now, this is, I think, being video, Elena. We've got the video, so it's on YouTube. Not. We don't do that anymore. But no, look, obviously the text of this is available. It'll be on the website. Now, look, if you still want to keep being informed about what we're doing, what we're changing, and there's progression of breakfast and information, get your business card, please, and put it in the fish pile. It's here at the door, I suspect. So if you want to keep getting the e-blast and the e-news from CHDC, please put your cards in there and we'll keep you informed of what's happening. But look, ladies and gentlemen, that's about it. As I say to you, please make yourself available to the speaker this morning. They'll be here for a while. Some people will be staying on. Thank you very, very much for your attendance and your support. And obviously keep looking out for CHDC and some of these advices in the future. So thank you very much.